Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Welcome back, yo. It is Saturday afternoon this time around because we had a little bit of an issue in the morning. The power grid where I do live just went fucked. So we were through a little bit of a blackout for a good chunk of the early morning, which is why I postponed the recording of the video to, well, basically now, which is after lunch. But nonetheless, they can try it, but they won't ever be able to stop us, right? We are not skipping it. Now, let's have a look at the week, which was now, from a price action standpoint, it was kind of like we were expecting it. A bit of choppiness here and there, not huge moves, at least not in the major market, so to speak. But, there was, there were a little bit of a surprises here and there, just, I think, minor, so to speak. But, let's have a look at the economic calendar. First and foremost, we are still dealing with all the delayed data now coming in, but let's have a look. So we got ISM manufacturing PMI, which came in contraction territory. As you can see, is below the 50. And, it's not that enticing, especially if you dig a little bit deeper beyond the simple result and you try to analyze the different components of the index. So as you can see, new orders, they dropped. From the employment standpoint of the data, it dropped again, or it declined, as it says here. And, on the other side, prices paid, they increased. So, the summary is that the effects of stagflation are now visible. Yeah, could be stagflation, I guess, slow economic growth, higher than normal inflation. You call it stagflation? Yeah, okay. I will always argue that for me, stagflation would see a much higher rate of inflation compared to what we got right now. Okay, it doesn't change the facts that we are looking at this phenomenon going around these days. So, moving on, we had the ADP employment change, the monthly report this time around, which came in negative minus 32K. The consensus was plus 10K. They revised the previous read upwardly, but still, if you check the recent trend, it's not that cool. We got more negatives reads than positives. So obviously, the labor market is struggling a little bit here. It's not, again, it's not in recession territory, but surely week after week, month after month, it is always more worrying, so to speak. We got then the services part of the ISM PMI. And this one is a little bit better, at least, it is in a positive territory, expansion territory, around 52.6. And I guess, again, just to reiterate, this is why, at the end of the day, overall, the economy is still hanging in there, because the majority of the economy in the US, at the very least, it's represented by the services. The ratio should be around 70 to 30. So 70% services, 30% manufacturing. Or, could be slightly different, but you got the gist of it, right? So services for now are saving the day for the broad economy. We'll see how long they can last. If at the end of the day we have a little bit of a, of a bounce in the entire US economy, we will see. I'm not that confident right now, but hey, it could happen, right? Now, we got jobless claims, which, if you check the trend, it looks like recently it's slowing down, which is good, right? Because we're talking people which are claiming unemployment benefits, obviously. And even if you check the 4-week average, it looks like it is decelerating a little bit. Now, that begs the question, how come that data points like ADP or NFP have been particularly weak throughout the last few months with bad revisions, bad data from the headline perspective? The unemployment rate it's climbing higher, and yet you don't see a lot of claims. You don't see the claims skyrocketing. So I think, I probably don't have the answer. But, a nice thought experiment would be, look, could this be demographics, right? I mean, maybe a lot of people are actually exiting the labor market because they are retiring, right? Aging population to some degree. And if you retire, you don't apply for the unemployment benefits, but you just get your pension at that point. And, the problem might be that you see unemployment rate going up because we are basically in a phase where there is no actual mass firing, at least for now. But at the same time, we are through a little bit of a hiring freeze. So companies are not hiring. So no hiring, no firing. But at the same time, every single month and every single year, you got new people entering the workforce. Like, think about young people, which maybe they were attending high school, or maybe they finished their college education path. And so now if you're not a student anymore, but at the same time, you're not finding a job, you fall into the unemployed category. And correct me if I'm wrong, I'm not an expert because I'm not American, obviously, but it would seem strange to me that you could claim the unemployment benefits if you never worked a day in your life. So feel free to correct me in the comments if you wish, or to clarify just for me. But just, my mental masturbation brought me to these type of thoughts to kind of reconcile the fact that the jobless claims are going down, but at the same time, the other data related to the labor market are actually weakening. Okay. Now, the PCE came in on Friday. I think for me, it's really like a nothing burger. Nothing really changed. And it's pretty evident if you look at this chart, right? It's basically at the same levels it was in November, December 2023. So sticky inflation, higher than normal inflation, surely higher than the Fed target, but at the very least, it's not skyrocketing, it's not plummeting. If it's not skyrocketing, it's good. If it's not plummeting, it's also good because it means that you don't have a crisis or a downturn in the economy or a financial Armageddon going around, which, by the simple nature of it, it should be deflationary, right? We ended up with the Michigan consumer sentiment, which, again, very weak. Look at the last 10 years, right? It's not good. And again, it started with COVID or with the pandemic, and then, it never really recovered. Now, before we move along, just a few things to complete the talks on the labor market. We have been looking at the unemployment claims. Now, if you check the continued jobless claims, what you see is that they keep on staying at relatively high levels. Again, so people which are losing the jobs are not able to find a new one, and therefore they stay on the unemployment benefit. So that's not good. It just tells you that it's hard to find a job if you lose your own, right? And then what we got, again, just to reiterate that fact, the survey about how hard it is to get a job or how available jobs are recently, it goes hand in hand with the unemployment rate, as you can see, which again, it's not a very good situation for the labor market as a whole. Then again, you should just dig in and look at the different sectors, or look at the different brackets of the population and all the rest. But just, on average, this is what the current situation is, all right? Now, we were talking about ADP before, and we have been discussing recently how government data were cut off because of the shutdown. So this is the 3-month change in payrolls registered by the ADP and the BLS. Now, of course, you see that the BLS stops here because, because of the shutdown. But again, for the data we got so far, it looks like there is a tiny divergence in those. Last time we were looking at that divergence, it was in here, right? With the ADP starting to come down. The official data kept on going higher for a little while. and then they plummeted following the ADP. So I still think ADP is kind of a leading indicator, and the NFP official data, the BLS basically, it's what is lagging at the current moment in time. Now, although we didn't have a lot of official data, and we're still catching up with them, I think there were many other sources of unofficial data. ADP was one of them, of course, as you can see, but there are others if you really want to check into them. Like we got the Revelio Labs, which are monitoring the non-farm employment situation, and I mean, even if you look at these, you see that this situation, it's not that rosy, okay? So that should be kind of like a double confirmation of the weakening we are looking at in the labor market. Then we got, let's say, Link Up, and they of course take into account the revised BLS NFP in dark blue, black. What's that, right? Then they got the consensus estimate in light blue. But what's interesting are these orange dots or squares, right? Whereas they are trying to forecast what the next data print for NFP will be. And again, the latest forecast, it's negative, as you can see. So again, not a very good situation for the labor market. Also, if you check the job postings, it declined to levels we weren't looking at for the past 5 years. So it's not cool, right? I would say. This is going to be interesting, especially because early next week we're going to have the JOLTS opening, right? So the JOLTS report, jobs opening and whatnot. So we will see how the trend shapes itself up, right? Now, sure, we have been talking about the K-shaped economy. I'm sure you have been hearing of that. And it looks like it manifests itself even in the amount of layoffs that you see, comparing, huge companies and small businesses, right? So you see at small firms and small companies with, a tiny little amount of employees, they're cutting jobs pretty substantially. Now, I'm not saying it couldn't happen to a big company, but usually, right, a big company tends to announce them and then slowly actually performing them. Look, if the economy is going to go south, everyone will try to cut costs and therefore cutting heads in order to preserve margins. I'm just saying that it's way easier to see this phenomenon going first in the small businesses because, they are not well equipped to resist a potential downturn as long as a very huge company, right? And it goes from, from liquidity, from cash flow availability, from revenues, and even from access to credit, if you want to throw it in there too. So again, just a tiny interesting aspect of the whole matter. Now, as for the break-evens, they bounced up a tiny bit, but still, you might say we can still observe this, some sort of a rounded redistribution if it was a normal chart, right? So again, inflation expectations, I would say not so high, maybe. Going ahead, we got the true inflation data. As for PCE, what we see is that basically we are at 2.10%, and over the last period, it really plummeted, right? The situation is a little bit different for the headline CPI as reported by Truflation. We are basically at the same levels we were in, end of October. So, nothing really changed over the last month and a half, something like it, right? Now we're going to have, next week, we're going to see on Wednesday what the FOMC will do as for rates. And of course, the market for now is expecting a cut, as you can see. I do believe we're going to see a cut. Probably, I would say an hawkish cut. Like, we are cutting, but just remember, inflation is not to target. So we are still worried about inflation. The job is not done and all the rest, right? I mean, we are cutting, but we can't really unleash the euphoria in the markets. Otherwise, it's going to be problematic to rein that in when the time comes, right? Now, GDP now, do you remember when we were talking, these data point right here, I'm not really trusting it because I'm not so confident that it's realistic. So it went from, what was that? Basically from, it was 4.3, 4.2 2 weeks ago, and now it dropped to 3.5 because, well, they are blaming it on what? Real personal consumption expenditures? Yeah, because it declined from 3.1 down to 2.7. So basically, the consumers are a bit tapped out. And if you don't have consumers in a good shape, it's hard to maintain those spending levels. And if those spending levels goes down, so it goes aggregate demand, and the economy just slows down even further, right? But again, just to appreciate the volatility in this data. And again, I'm gonna say it again. I don't think the final GDP figure for the year 2025 is gonna be nowhere near around 3%. I think again around 2.2, 2.3 if you're lucky. But I'm definitely not seeing a 3%. All right. Credit spreads are low, so together with the VIX, everything came back into very safe territory for now. There is not a major worrying on that front, right? So that would conclude the initial stage as for the economic calendar and the data. So now let's have a look at some charts, shall we? Oh, you know what? Let's make a little bit of a turnaround when it comes down to charts. Let's begin with, well, I don't know, oil, just to shuffle things around. So oil, I mean, again, it was choppy. Yeah, it was grinding to the upside. And if you remember, we were looking at this tiny little descending channel right here. It looks like we are seeing an attempt to break out of it to the upside. Now, again, to me, the real point would be trading and maintaining above this high in red right here. Like, I do like channels as everyone else, but I put more weight on actual key swings, highs and lows. So, I mean, it's a good start, I guess, if you want to be bullish, but I would prefer to see these high taken out and potentially traded and maintained above. Otherwise, for me, it is just still a ranging behavior. Yeah, it could be a bit down, then a bit up, then a bit down. And, realistically, zooming out a little bit, the level for me is always the same, and it's this one right here, right? Up until the point we are below 62, I can't be massively bullish oil, right? Nothing else happened in the oil market, so I guess that's a quick one, and this is why it was first, right? Let's have a look at gold instead. I mean, we're still tapping into these apex. The good thing, again, let's try to analyze the bullish perspective first. The good thing is that we kind of came into the region, in the middle of November, and we saw a sharp rejection off of it. Now we reapproached it a bit more efficiently this time around, comparing this leg up to this leg up here, right? And the rejection, has not been as huge as it was here. So as you can see, a little bit of a reaction. We were rejected down, but, even this tiny daily candle right here was, immediately reabsorbed to the upside. Then again, a little bit of a choppiness. And on a Friday, we had a little bit of a spike to the upside, rejected, and we closed. I guess we closed on a little bit of weakness, but I mean, I wouldn't read a lot into it. And quite honestly, at this point, I think even if you imagine this market pulling back a tiny bit, right, before actually trying again higher, that would be even better for me. From a medium to long term perspective, a much more efficient move, well built up, organic, very structured, very ordered. Yeah, I would prefer that, to be quite honest, instead of a moonshot, which then exposes you to some sort of a throwback like this, what we've seen a few weeks ago at the end of October, right? And well, then again, if you just if you want to be bearish. I guess you would wait for this market to actually calm down, stalling a lot around the lows, and then finally break them and going down, I guess, right? Which is not my base case at the current moment in time. As I said last week, I'm maintaining a kind of, a bullish stand on gold for now. We'll see. Probably it won't come all together and it won't come overnight, but I mean, I'm seeing it constructive, right? Now, let's have a look at Bitcoin instead. And again, Bitcoin played out exactly as expected. We had this choppy behavior. And if you remember, we were looking for a potential test down around the current lows, but it was kind of indifferent if you remember, if it was slightly above it, slightly below it, but just a test down to the lows and then potentially a little bit of a choppiness throughout the week. Now, I still think we will keep on seeing choppiness in this range right here. Right now, we are struggling to get back above this old shelf bottom, as you can see. So, I would say up until the point we can't at least reclaim the 94, 95 region, I wouldn't be super bullish, right? By the same token, I wouldn't be massively bearish up until these lows are protected. So again, I'm just expecting choppiness. Nothing really changed, even in this market for me. I do believe if the stock market can really hold itself up together and potentially we see a Santa Claus rally, at that point, I would be a bit more positive on Bitcoin and potentially, although it might look sloppy, but something like it going into the end of the year, right? It goes up, comes back down, goes up, comes back down, goes up, and then when we come back into this region right here, I guess that's where the moment of truth actually is, right? Because if you see this market pulling back and then being faded, at that point, it's a very bad sign, right? For me personally. But if you see it being able to climb itself back up and then maybe retesting a little bit down, but maintaining itself, kind of establishing a new range in here, you could be a bit more positive for a potential try higher. But I think, we are talking at this point in 2026. I'm not expecting this entire thing to unfold itself in the remaining 20 days, more or less, of December. I've seen crazier things happening in Bitcoin. Yeah, sure. But, it's just to build up a model for expectations. All right. I guess a lot of people were talking about what's going on currently with Michael Saylor and strategy, because now you can't call it MicroStrategy, right? It's got to be strategy alone. Otherwise, it doesn't really transmit that sense of mightiness and power, right? It has to be strategy. Now, look at that. I think a few people, maybe a lot, were disappointed in seeing this shift in the tone. If you remember, Michael Saylor was famous for a few quotes, right? I mean, some of them were actually hilarious. Sell a kidney if you must, but keep the Bitcoin. Yeah, sure, why not? Those Bitcoins are gonna they're gonna make you so good after you're dead. So yeah, sell a little bit of your organs, but keep the Bitcoin, right? Yeah. And I remember the other one about mortgage your house and buy Bitcoin. Yeah, sure, right? Why not? Okay. Now it looks like the tone shifted now, and even the CEO is saying that they would. We're talking hypothetical. Yeah, right. It's not a certainty. It's just a consideration. They could sell some of their holdings, of what? Obviously, of Bitcoin, since MicroStrategy doesn't really do shit. It's a zombie company from the .com bust. They have, negative earnings, negative revenues. They should be bust at this point if it wasn't for the fact that they transformed the company in an ETF on Bitcoin, right? So, I mean, they would consider to sell if the market to net asset value should fall. So basically the market cap, I would anticipate, right? And if it would be much more difficult to raise new capital. Yeah, sure. So one of the two things is actually going on. So the stock is now trading at a discount relative to the NAV, right? And the ability to raise capital, well, diminished, right? To put it lightly, right? So I guess maybe at a point they will be forced to sell a few, not all, a few of the Bitcoins. What they've done is that they established a reserve, a liquidity reserve or a liquidity cushion, which, just mind you, it's denominated in what? Bitcoin? No. Gold. Gotta be gold, right? Safe haven. No. So what? In US dollars, right? Why not? Because at the end of the day, when we talk about liquidity and people are worried, what do you need to show up with? The good old dollars, right? So, yeah. I mean, I think it's just normal, but because, what happens if you have those convertible bonds, right? If the stock plummets because Bitcoin sees a downturn, nobody would want to convert the bonds with the shares of the company. They would just ask for the money back. So you need to have the money back. That all being said, I don't think strategy is going bust in the next 6 months or 1 year, right? They got a good enough cushion to survive. They just need the market to recover. And they have a very good window of time for that to happen. So yeah, I mean, it's fun. The troll, I like the troll like a lot, but realistically, I'm not expecting them to go out of business anytime soon. It is just what it is, right? Now let's have a look at currencies. The usual exotic currencies did a few of them did fuck all. Like or should we say more of the same? So Chinese yuan up again, South African rand kept on going higher, right? So we were in the middle of this dealing range. We pushed to the upside for new highs now, so good, I guess. The Indian rupee kept on being weak, all right? And then we got, I don't know what went on in Brazil for the Brazilian real to drop like that on Friday. I don't actually know. The ruble, we were looking at these. We said, well, I mean, we reclaimed the apex base, we reclaimed the point of release, which confirmed this apex as an apex and this base as a base. So expect a little bit more of an upside. And there you go, a little bit of upside. And the Australian dollar went up like a lot. It's not the only one. I don't know about the Aussie dollar, but I was looking at the Canadian dollar right here. Now, I know that on a Friday, they got the unemployment rate coming in, and it was very positive, if I remember correctly. I think it was expected at 6.9, and it came in at 6.5, and it's down from 7%. So, 50 basis points drop in the unemployment rate. That must be a positive. And the currency would react to that, I guess. Especially after being weak, for a good period of time. But other than that, I don't know a lot of what's going on in Canada. I'm sure Roman will be watching it. So, Roman, if you got a little bit more of insider information, just let me know in the comments or hit me up on Discord once you stop arguing with Modi about Bitcoin and who's got to be bear and who's got to be bull, right? Yeah, I'm watching you too, arguing right now. That's funny. But let's think about ourselves here. Let's move along. Now, wait a minute. We didn't check or double check. The euro and the pound are actually, at the end of the day, that divergence with the DXY played out really well. Now you go further expansion up for the pound, and the euro finally broke out of these high. So that's good. Now, as for the Japanese yen, how can I forget about the Japanese yen? Everyone is talking about the yen carry trade unwinding, and I was just skipping it like that. Bet me. Now, again, last week, if you remember, we were looking at the interest rates differential on the two different benchmarks, right? We were looking at the 10-year Treasury yield in the US and the 10-year yield on the JGB. And although, that spread was narrowing, the currency, so the yen against the US dollar, was still going down in the same time span. So now, because the BOJ is signaling that they're going to raise interest rates, do you think the carry trade would be unwound? I mean, I get the point. They would, how can I say that? It would be less convenient, right, to keep on borrowing in yen if rates are going up in the yen denomination, right? And if they are coming down in the dollar denomination, because, if you think about one of the carry that they do, they borrow in yen because you pay a very low interest on the funds that you borrow. Then you swap it into dollars and you buy US Treasury because, the yield on that, it's much bigger than what you're paying on your yen denominated debt, right? So you're capturing that spread. If the spread narrows, there is less convenience in performing that arbitrage right there, okay? That's just one of the things for what people do the carry trade, right? Another one would be, doing the same, borrowing in yen, swapping into dollars, and then buying risk on assets in the US. Better returns, and the returns are denominated in a currency which is appreciating against the one you borrowed. So double win, right? I get it. I don't yet see a reason for a very quick unwind, right? Like what we saw in August 2024, because that would imply the yen skyrocketing, spiking against the dollar. And I'm not seeing that. So either people are talking about it just, in advance, but it's not reflecting in the charts, or could this be one of those self-fulfilling prophecy? While people expecting it to come, so they will act as if it's coming, and they're gonna cause the same thing they're trying to prepare against. It wouldn't be the first time you see it happening in markets, right? Or in the economy, or in finance in general, right? But I would believe it when I see the yen kind of accelerating really sharply to the upside. For now, not yet. And again, when it's going to happen, you're going to see a lot of risk on assets plummeting, stocks, Bitcoin, even gold, right? So just be aware of that. But I don't think we are there yet. We could, yeah, everything is possible, but I'm not seeing it in the charts. As for the DXY, yeah, came back down a little bit. I think, we already discussed what's going on in currencies while checking the others. If anything, let's zoom out on a monthly time frame like this, right? And then let's have a look at these. So the DXY, it's just an index, obviously, and major, for the most part, 60% more or less, it is weighted against the euro and the yen, right? But if you check the dollar trade weighted index, which is basically the dollar, but weighted considering the volumes that he registered when it comes down to trades, right? It's it pulled back, yeah, but it's not as bad as you would think by just looking at the DXY. And if that's not enough for you, we got another one coming right in here. Look at that. If you check instead the trade-weighted real broad dollar index, yeah, I know it's mouthful, but basically it's kind of the same of the green line, just with the addition that this one is real. So it's inflation adjusted. And it looks like, the dollar is not performing that badly against a lot of other fiat currencies, right? So again, you can just read it or look at the charts in here. Yeah, a lot of narratives going around the dollars every single time. And at the end of the day, it's still there. So yeah, Unfortunately for me, I'm in the camp of those which believe that the dollar is not going anywhere, and it's probably going to be still the major currency, if not one of the majors for my entire lifetime at this point. But it's a little bit of a curse because you always have to explain to other people why you think it's gonna play out like this, and why history says probably up until the point something valuable comes out to replace it, it's still gonna be the big daddy. All right, now let's transition into yields, since we talked about incoming FOMC meeting. Right now, yields came up particularly sharply, I must say. Now, we had the drop, right? We were looking for the drop, right? We got it. No new lows, which is, is this changing behavior? I mean, if you zoom back, if you check this fragment or this section of price action right here, there was a period where it didn't go for a new low. It came all the way back up and then eventually did. So, I mean, never say never. But, in the very short term, no new lows. We are still in this range, basically. Now, I'm just looking at the 10-year for reference, but you can see it's kind of the same on the others, right? And I think a lot of that is due to the fact that, again, the bond market is waiting for FOMC and for what the Fed will signal. And, another part of that, again, another thought experiment, right? Could this just be related to the fact that, since we are looking at the yen, kind of trying to put together a short-term bottom, maybe, could this be the Bank of Japan? It is actually selling U.S. Treasuries, since it's one of biggest holders of U.S. Treasuries, just to defend the currency or to prevent the currency from collapsing, and therefore you see bonds down, yields up, and the yen kind of finding a footing down there. Because again, we were discussing, well, if the yen starts to crack these lows, if you remember 2 weeks ago, 155, 160, at that point, we are really in the no bueno zone, right? So, yeah, that could be one thing. Just a thought, right? Conversely, what we've seen is bonds really taking it on the chin and having a very bad week. Now, there is maybe a little bit of a divergence. It's not confirmed yet, but you see the long end broke these lows. The 10-year didn't yet, and the 2-year, no, absolutely did not. So, it's too early to tell to confirm that divergence, but might be worth monitoring going ahead. All right, and that would be all I got. So let's transition now into the stock market for the week. As for the stock market, it was a little bit as expected, a bit of choppiness. We were talking about these first 10 days, 2 weeks of December with mutual funds distribution. So expect a little bit of weakness here and there, expect a little bit of choppiness. Now, having a look at the market or at the different sectors, what you see is energy is up, okay? Information technology is up, industrial up. I guess the big point was XLK coming back up. And look, what might be one of the biggest losers? Do you remember what was overperforming? Look, it's the healthcare sector, right? But would you believe that? Another rotation. This market is rotating a lot, right? And you can see it even if you check a different type of layout like this one. You see the healthcare, it's for the majority is red. Lilly lost almost 8%. It's nothing huge. It was up massively after earnings, but again, just another testimony that what goes up massively needs to cool off. And what is out of favor for a while sooner or later it will rally. It's just normal market rotations, right? Up until the point you don't have a credit-related event, right? So with that caveat, all else being equal, money, it's like matter. It cannot be made up or destroyed. It just transforms itself. So it flows from one asset class to the other. And even in the same asset class, it can go from one sector to the next. And even in the same sector, it can go from one stock to the next, right? So there is nothing new there. But beside that, let's have a look at the charts. So as you can see, again, this is the week, basically. Yeah, I mean, overall, it was a positive week, all things considered, especially for, the Russell, even more than the two major indices. But, we are mostly focused on the ES futures, or the S&P, and NQ, or the NASDAQ, or the Qs, if you want to look at the ETF. And we got what we were expecting. Yeah, I mean, the market overall, it kept on slowly grinding higher. But as you can see from all those wicks and those shadows on the daily candle, there was a lot of back and forth, right? Ironically, the Dow was, much stronger, and even the Russell. Yeah, I mean, down on Monday, but then it recovered, and it just traded more sharply relative to the others, right? So if you zoom in and you start to look at what happened on Monday, you see that the weekly open is there, this tiny little line, and we immediately shoot down in the Asian session. So Sunday opening is down. Then we spent a good chunk of Monday going around in the London session, therefore overnight. We came back up to the weekly open, test back into it, rejected. So a little bit of a rejection. We came back down, then up again. And there was a lot of choppiness in here, as you can see, up and down, up and down, up and down. And eventually, we had another push to the upside, another sharp drop. And finally, when we transition into Thursday, what do we have? Oh, well, a little bit more of the same, you say? Yeah, exactly. So, I mean, look, it was a difficult market. It depends on how you trade. If you're mainly betting on trending moves, it was in a very difficult week, right? Sorry, it was a very difficult week. Oh, if you do like very short-term volatility, though, and mean reversion especially, well, then it was a fantastic week for yourself. But nonetheless, the week was as expected, all right? Finally, on Friday, let's try to zoom out a tiny bit, right? Okay. On Friday, as you can see, it looks like we finally managed to break out of this current range, right? Out of the highs right here. We tested back into them. We came up, but I don't know, the close that we've seen, it's not really a strong close, right? If you look at Friday alone, right? Yeah, I don't think it's a strong close. Even if you look at the volume profile right here, we closed around the point of control. So yeah, the majority of the volumes were done in here, so not at the tails, but really in the center of the range for the day. It's not very conclusive for me. So again, next week I would expect a bit more of one and the same compared to what we've seen this week. So, let's get back to a zoom out chart, right? So probably, I can't say I'm bearish this market, but, a test back again. And yeah, again, kind of like with gold, what about a little bit more of a deeper test, maybe around the 21 exponential, to really kind of calling up and potentially then maybe really charging up for the end of the year rally, right? Yeah, wouldn't be unusual in my view. Again, maybe it would be even more healthy to build up that energy to then push up in the end of the year, right? The stochastic, it came back up in overbought territory. RSI, it's pretty neutral, not a lot into it. But again, I think a little bit more of what we've seen this week. at the very least, at the beginning of the week. Then, with the huge catalyst of FOMC in the middle of the week, Thursday and Friday could be a bit more directional. But again, up until that point, I wouldn't expect something, hugely different compared to what we just seen. Obviously, the catalyst of Wednesday doesn't really tell you a lot about direction. We will see about direction. It depends on what they say. I'm leaning up, but hey, the market could always surprise you, right? So overall, I maintain my bullish bias on the market for now, up until something drastically changes, right? So let's have a look at a few slides as usual, because I'm just gonna keep the chapter on the stock market relatively small, because nothing happened. It feels like the biggest news of the week was Netflix buying up Warner Bros. For what, 80, 90 billions? We had a tiny little news which went on for what? It lasted for 2-3 hours. Microsoft saying that, the AI-related software sales weren't so good and they might have to revise down the quotas. And then, after a few hours, they just backpedaled. So again, I remember I was like, okay, it looks like Microsoft is trying to fuck the market for like a few hours, and then it won't matter anymore. And probably next week, we're going to see new all-time highs. Might be a little bit of an exaggeration, new all-time highs next week, but just to prove the point that, but it's not going to count at the end of the day, what Microsoft said. Case in point, they took it back. So let's have a look at some slides. Now, for the long term, so to speak, what we see now is that, again, everyone is talking about valuations. Valuations are too high. Therefore, this market needs to collapse. At a point, valuations will count. All right, they will matter at a point. What if it's not? If we are not at that point yet, right? I've been hearing to people talking about a 40-50% drop in the S&P for, basically since the pandemic now, right? The 5 years, every single year. You know what? Next year, we're going to see the biggest drop in history because of XYZ. Okay, at a point, we're going to see it. We're going to have something similar to the GFC or to the dot-com bust. Yeah, sooner or later, usually, yeah, absolutely. But what if it happens in another 10 years, right? Or what if it might happen over the next 6 months, but what if, when it happens, the S&P is really at, 7,500? If we drop 40% from there, it's very different than dropping, the same amount from here, right? So it's always a little bit of a, again, I'm the first in line. I do like mental masturbation, like a lot. But just, try to, keep it in the back of your mind, especially if you're investing for the long term. But, up until the point the Luna Park is open, hey, you gotta roll, okay? Just bear in mind, you need to manage your risk, always be aware of the risks, and always have contingency plans to manage them, right? Then, look at that, even margin debt and free cash balances, right? High, because we are looking at a very huge risk appetite in the market. The investors, especially the retail investors, they are buying every single dip. It's nothing new. It's just a summary of what we've seen so far over the last few months, especially the last, basically after the April drop, so the last 2 quarters, right? But this is just the reality of it, right? We are deviated from what should be the linear trend, right? So as you can see from the past, there is a regression sooner or later. We go back to it, then we drop, then we go back to it, then we go above, and then back below it, back above it, back below it, back above it. At a point, we will come back toward it, and then we'll see what happens. But the timing is always the most difficult thing, right? Now, this is this is great. Do you remember? And actually, I just to prove you that I shit you not, but in the past, I already brought this up. I got it in this folder, right? And it was, if you can read the date, although in Europe, we invert the day with the month. But as you can see, it was November the 8th. And we were looking at the same exact chart, right? Which was obviously this one right here, right? The consecutive monthly advances, right? Now, I included it back because we were saying, look, it is true that oftentimes when we have 6 months straight of advances, right, we are due for some sort of a correction. Okay. But it is also true that if you just look at this sample size, every time, if not one, this one right here, we got up to 6 months. Before correcting, we went up another month to 7 with the outlier of this one, right? So now check this out. Ah, looks like we went up another time. Now, a little bit of a caveat. Like I do know that if you check, these chart right here, right, it doesn't look so, right? Because you see that the previous month on both the ES futures and NASDAQ futures, it closed negatively, right? But if you check another chart, let's say I was looking at it just previously, let's use this chart right here. If you check the ETF, so the Spiders ETF, and if you go on the monthly chart, and if you get rid of these, which we don't need that now, okay? What you see, yeah, the month overall closed slightly negative, but if you really zoom in, what you see is that we got the open, right, which was above the previous monthly close, and the close, which is above the previous monthly close. So that's, it's an advance in technical terms. And even if you look at the index, right, let's take this one, it's kind of the same story there, right? See that? There is also a tiny little bit of a gap in between the previous monthly close and the open and close of the new month, so the month of November, basically. So again, these stats here, they hold water, it looks like, although marginally at the end of the day, but again, oftentimes it's just another way of saying, yeah, I mean, we got that 5% correction in November and everyone was screaming, the bear market is here. And it wasn't, right? And the stat that combined, again, you remember the Black Friday week, the beginning of the festivity, the stat going back to the 50s of the last 6 days of November and the first few days of December being massively bullish. It looks like sometimes, not every time, but sometimes these stats, they actually do matter, right? So this is why I'm checking them all the time. Just, to see if they are confirmed or denied, right? Now, after that, breadth has been a problem for a good chunk of time now. It looks like it is improving slightly, although, it's not back up to levels which should correspond with a very good, healthy market predisposed to go up without any major issues or hiccups. So again, the situation improved a little bit there. It's not optimal yet, but surely it's still better than seeing it deteriorating, right? So this is another one which I'm guessing is a semi-good news, if you want to take it like that, all right? Then what we got, this is more on the worrying side because we are looking at a market where there is a huge deviation, which obviously tells you that the market has been bullish all along, but, we are reaching into levels that, we don't see very often, right? And I'm just going to zoom in if you want to read the comments, all right? Again, these are long-term type of topics. So just because we are deviated now, it's kind of like with valuations. It doesn't mean that the market is going to crash tomorrow morning, but just keep it there. It might be relevant maybe a few months down the road, maybe a quarter or two down the road, right? Okay. Then moving ahead, what we see Well, again, another form of breadth, if you wish. It's basically we are looking at what the S&P would be if we do exclude all the AI names, right? Of course, we're talking the situation before the advent of ChatGPT. So the market would be up what? 25%. 8% compounded annual return, which is kind of the historical average for the stock market. But if you then include the AI names, it went up 3 times that, 73%. So, I mean, we're looking at excess returns, I think, over the last 3 years. At a point, this whole process, although it's multi-months, multi-years, but this whole process will need to be reversed, right? There will be a catalyst in the future. We don't know when, we don't know how, we don't know why. There will be something which just trigger a mean reversion type of process, right? I know it's just like, Sherlock, at a point we are all gonna die. You didn't tell me anything new. If you could tell me when and how, or how I can avoid it, well, I know it's impossible, but for the sake of it, right? That would be much more useful. Unfortunately, nobody can, right? It is just to lean on the fact that these returns are not normal, right? So if you're planning for the long term, and if you're thinking about the next decade for your investments, well, just be aware that we could go through a period where we will see below average returns because we are coming from a period of above average returns, right? That's the point, right? It's not about calling the top once again, okay? This is the seasonality for December. Now, this is interesting. So usually December is one of the best performing months for the S&P. Not only that, but if you remember, 2024 was negative. And, Carson is just highlighting the fact that it's very rare, right, to see 2 negative Decembers in a row. It happened in 2014 and 15, but that was the only case over the last 25 years. I mean, 24, because technically this is the 25th year. So again, another reason to lean bullish on December. And even if you check just, 24 years, how many times December was red? 1, 2, 3, 4, 5, 6, 7, 8. 8 is what? 8 out of 24. It's basically 1/3, right? So, 2 times out of 3, December closed positive, right? Or slightly positive, whatever. So, I mean, we should lean bullish for the month of December, right? And then we get a few stats on the Santa Claus rally. And again, you see the same pattern, right? The first 2 weeks of December, you see a little bit of a choppiness, a little bit of weakness. And then, historically, we go up for the Santa rally, if the Santa rally comes, right? And again, this is data taken from the 50s. So 74 years of history and stats. It's not something that you should discard. With a good caveat that, of course, statistics are not the Bible, right? At the end of the day, it's a percentage, it's just a data. It doesn't mean that this time around we couldn't see December being negative or the Santa rally not coming. But, if you were a betting man, what would you bet on? Just play the odds, right? Since you don't know the future, the only thing you know is the past performances, and therefore an educated guess which could be made on those bases, right? You don't have anything else at a point, right? Unless you are an insider or you have access to privileged information, or you are one of those big guys which is actually moving the market, right? So you don't need to know or to anticipate where the market will go, because you will drive the market where it needs to go, or where you want it to go, right? Okay, so the sentiment is improving as well, right? For the individual investors, as you can see. This is still that famous association of individual investors. Okay. And you see that the sentiment is now for the first time in a while, transitioning to bullish. So you see the orange line coming down, the green line going up, and of course the delta is inverting right here. So sentiment is improving. Bread slightly improved. I guess, liquidity should improve because QT ended. So now we are just waiting for the next announcement of, saying we are implementing QE without saying it, right? So another form of stealth QE. Rates should be coming down. Yeah, okay. If there is nothing fucking around in the repo market, we should be good, right? Although I think, again, the risks are not completely eradicated there. So it's another sector of the financial markets to keep an eye on. But, up until the point it doesn't blow up, it's like the carry trade. It's all good up until the point it's not. But yeah, right. So as you can see, I think there are, let's put it this way, on my whiteboard for now, there are more points in favor of the bulls than in favor of the bears. So I'm leaning bullish, obviously. And finally, and this was a theme which went around for a good chunk of the year, and especially, it started out in 2024 and it went on up until the middle of 2025. So basically after the drop with tariffs and whatnot. You remember, well, you shouldn't be exposed, or you should de-risk in US stocks and the US markets in general because, probably Europe will overperform. Well, okay, maybe, right? I didn't believe that back then, and I don't believe that now, but just for the sake of it, look at the flows for 2025. Where did they go? We're talking about billions, right? Equities? Oh, look at the US. Oh, and look at Europe. All right. It looks like not a lot of people took that advice as it was, the absolute truth, because they did the opposite, right? You want to look at bonds? Oh, well, look at the US Treasury market. Not only compared to Europe, but even compared to equities. We got more flows in 2025 going into bonds rather than equities. So again, right, must mean something, right? And, since we're talking about flows into bonds, before we conclude, let's have a look at these. Now, there is no deny, we're looking at the TLT as a proxy here for the bonds, right? There's no deny bonds have been in a bear market, essentially, right? But what's interesting, from the technical standpoint, it looks like they're working on, building up a little bit of a pace around the reaccumulation, whatever. I'm sure, actually, I just noticed that. I'm not sure, but, you got your initial spike, and then it comes back down, and another spike again, comes back down, and then could this be Wyckoff accumulation? Okay. I'm not gonna jump ahead of myself, but nonetheless, it sounds like reaccumulation, nonetheless, right? So technically, we might be set up for a little bit of a rally in the TLT again. Probably for the long term, you might wait a few weeks or months to see it unfolding, since the bond market trades so slowly, more often than not. And then what we got, the positioning, right? The allocations, right? Nobody likes bonds, right? And if you remember a good old Wall Street adage, it's that, you should buy the things. I mean, if you do believe in those things, right? You should buy them when nobody else wants them. Usually when everyone wants it, it's the time where you should sell it. And it looks like, for now, there are not a lot of people interested in bonds, considering the allocations, right? So again, it would be another point in the favor of maybe over the next few months, right? We'll see this trend being reversed a little bit. It's kind of the same I was talking about oil. Like there will be the time oil will shine because, the sentiment on oil is down, positioning is down, and probably there is a huge short interest built upon it. It's kind of the same. It's essentially the same dynamic at play. So now we got the technical backdrop, right? We got the allocations. We got the sentiment, obviously, the US debt, the deficit, the drunken insolvent Uncle Sam, the dollar is doomed, all there. So we got the sentiment part and the narrative part there. So we just need to wait for the sentiment to shift and the narrative to fade, because obviously the narrative at a point will fade, as I was hinting at when I was talking about the DXY, right? And we got the positioning in the sense of the short interest. Now, just pay a little bit of attention. Just because the short interest is high, right, that doesn't necessarily tell you, right, which are the specific levels where those shorts will be triggered to be covered, right? I mean, you can imply it. You see it started to go up massively, especially in here. Let's zoom in, right here, basically, right? So you could say, okay, as soon as we start to trade back above these highs, we might see a few short, which needs to cover. Yeah, but it doesn't really give you the precise level, because you don't have the amount of volumes historically at those exact levels. I'm not saying there are no tools to see that, but nonetheless, this is just a visual representation, which at least should make you think, I mean, so I wonder what happens if we start to crack a few relevant highs, right? Just, again, another one would be, look at this one, which would correspond to this one. So if we start to get, basically above these highs right here and back into this region, I mean, it looks like the short interest went particularly ballistic there. So if we get back to test those guys, they might get spooked and they will cover. If they cover, you're going to see a sharp rally, considering the huge amount of open interest on the short side, right? So again, another reason to potentially, seeing a reversion in the coming months on bonds, right? Which is, again, it is also in line, just let's add in a fourth piece of the puzzle. It would be in line with what? What are we looking at every single time at the beginning of every single video? The macroeconomic backdrop, so all the data. And what we're looking at is the labor market is not that, good. What happens if the labor market is not good? The labor market is not good, therefore, aggregate demand goes down. If aggregate demand goes down, the economy slows down. If the economy slows down, what's going to happen? Yields are going to come down, because they are a reflection of growth and inflation expectations. And there is an inverse relationship in yields, in between yields and bonds. So yields down, bonds up. So, when all those different pieces of the puzzle starts to fall in the right place, you will see that even bonds, although everyone hates them now, will come back to a little bit of a mean reversion. I'm not saying the TLT is going to get back to the highs, but I do think we're going to see a little bit of a surprise there sooner or later. It's just the natural tendency of the markets, right? Now, that being said, I think that's all. Also, because it's almost 5 p.m. and I would like to do something enjoyable this weekend. Also, it's going to be a long weekend for me, because it's national festivity on Monday, December the 8th. So, yeah. With that, I'm going to leave you off. I hope you're going to have a very nice Sunday at this point. And just enjoy the free time. We will be back next week for another recap, and we'll see what's going on. Up until that point, as usual, be nice and be cool. Niels out.